Ladies and gentlemen, welcome to our 19th Annual Investor Day. Today we mainly review unlisted companies in Vandel's portfolio. I am André-François Poncet, Vandel's Group CEO. With me today in person are David Darmon, Deputy Group CEO, and Jérôme Michiels, Executive Vice President and Group CFO. We also have our investor relations team, Olivier Allot and Lucille Roch, who are in the room with us. David, as Deputy CEO, and Jérôme, as EVP, have now been in their respective capacities for over 1 year. And combined, they have about 30 years of experience at Vandal and a lot of positive energy, which I'm sure will transpire today. We pray that you're all doing well. And quite frankly, we also pray right now that our internet connection allows a productive session. Obviously, we would have preferred to be with you in Paris, as we usually do, but circumstances have made this impossible. So right now, we're in TV Network's facility in Paris, complying with all public health guidelines, and we have done everything we could to ensure that the meeting is the most interactive possible. If technical problems occur, we apologize in advance for these issues. We will be joined via internet connections by 4 CEOs of Vandal portfolio companies. Loïc Derrien at Chromology, Huub van Beijeren at Staal, Pim Vervat at Constantia Flexibles, and Tony Jace at CPI. They will each make a short presentation and they will take your questions. I shall first provide a general update. Jérôme will present our current trading and our September 30 NAV. And finally, David will update you on portfolio management and investment strategy in the context of Vandal's 2024 roadmap, which is currently being devised under his leadership. I trust that you will particularly enjoy our CEO's presentations. It is a unique opportunity for you to put your finger on the pulse of what is going on in important parts of the world economy. And this is one of the fascinating parts of your jobs and our jobs. For obvious regulatory reasons, IHS will not be covered today. Neither will Bureau Veritas, which weighs heavily in our NAV, but which has its own investor and analyst events. I'd rather tell you right now, so you're not surprised or disappointed later. A quick word on BV, though. We are proud with the way BV, led by Didier Michaud-Daniel, has handled the current crisis. You probably saw that they beat expectations for sales in Q3 by quite a bit, and that they're on a good path for sales and margin recovery, provided the environment doesn't deteriorate significantly. Importantly, BV's financial communication refers to what Didier calls the green line. It's a concept you may want to get familiar with in BV parlance. It's the numerous services and solutions which benefit from tailwinds, as well as the significant development opportunities relating to all facets of sustainability. Very exciting. We feel that BV is no longer the cyclical France new build and oil price exposed firm that it once was, and this perception is expected to change materially going forward, as highlighted by recent analyst research reports. On slide 3 in front of you, I hope, about process today. When we get to Q&A, if you would like to ask questions, you can do so either by writing directly via the web platform or by calling the telephone number in English, the one referred to in UK here. Just note that unfortunately the French line doesn't work for Q&A, so French speakers can also use the UK line. We're still before Brexit. So you will have simultaneous translation, and I trust this will work. In either case, presenters will address your questions at the end of their presentations. Now, onto the update. I'm speaking from slide 5. Vandal's NAV stood at 145.3 euros per share at September 30, up 4.9% since June 30. Positively impacted by an increase in listed peer multiples and by updates in aggregates used for the valuation of our unlisted assets. In this 145.3 euro figure, CPI is held at cost as per our methodology. Its valuation will move to a comparable company-based approach starting December 31st. But Jérôme will give you some more color on this with a directional approximation of what this valuation might become. Our discount to NAV reached a very high point at 44.4%, and we will come back to that. Regarding the business, 9-month consolidated sales reached 5.5 billion euros, 9.1% down overall, and down 7.4% organically. Our financial structure was and remains very solid, with an LTV of only 6.4%, with modestly leveraged portfolio companies, for the most part, and with roughly 2 billion euros of liquidity. I'm turning now to slide 6, and I remind you of several actions which were taken this year to date at Vandal. The sale of our remaining stake in Allied Universal, maintaining our dividend in the face of potential pressure in France, right-sizing our international office footprint, which you may or may not realize meant letting go roughly 15% of our company's staff, which is a significant step, accelerating on ESG, and transferring our Cebo shares to the company's lenders' investment arms in an orderly manner, which we hope will benefit the company in due course. At portfolio company level, on slide 7, we've been very active. We recruited a new CEO for Constantia, Pim Vervaat, who has an outstanding track record at RPC. And for those of you who have not met him in his RPC days, you will meet today for the first time. IHS successfully amended contract terms with key clients in Nigeria, and the company announced exploring a potential registered IPO in the United States. Stahl successfully amended and extended its debt, benefiting from favorable conditions. We worked closely with our companies to address the COVID crisis. Each one was a special case. Some were more impacted than others, but all focused on health and safety, on costs, on cash preservation, while retaining growth options, and while rolling out compliance and ESG programs. Very busy. Several have pursued or are pursuing acquisitions in a disciplined manner, of course. We expect to keep management teams motivated in what are extraordinarily difficult times at personal and at professional level. On slide 8, we list some attractions of the Vandal story at the present time. A simplified and more agile organization. A financially resilient and refocused portfolio overall. Comparably low leverage, both at the level of Vandal and its portfolio companies. A stable, and we hope a well-defended dividend, generating a roughly 3.5% yield at current levels. Cash on hand, which is plentiful and available to be deployed for investments. A high trading discount to NAV, which is way above the average of the past 10 years, even accounting for the upcoming write-down on CPI, which we hope and we believe does not reflect meaningful value loss. Lastly, for my part, on slide 9, and related to the above, we plan to reinitiate an opportunistic share buyback program of up to 0.75% of issued capital by the end of 2020, which is the regulatory limit for Vandal in light of our ownership structure. As a reminder, the firm has returned 1.8 billion euros to shareholders over the last 10 years, roughly 60% through dividends and 40% through share buybacks. I would add that on a personal note, I'm considering ways to acquire more shares as well. Jérôme, the floor is yours.
Thank you, André, and good afternoon, ladies and gentlemen. I will now go through the Q3 trading updates, our net asset value, and our financial situation. Let's start with the update on consolidated revenues on slide 11. Overall, 9-month sales came in at roughly 5.5 billion euros, down 9.1% in total and minus 7.4% organically. Whilst the organic trend has been improving strongly over the third quarter, the negative impact of foreign currencies has been accelerating, with minus 4.2% in the quarter. As you will remember, the second quarter was where the impact of the various lockdowns throughout the world was felt by our most affected portfolio companies. Most lockdowns being lifted in May, June, we have seen a good recovery of your Q3, translating into a less negative organic growth of 3.4% versus minus 15.6% in Q2 and minus 9.5% for the first 6 months. Moving to slide 12, when looking at monthly sales, indexed at 100 for the graphs displayed here, you can clearly see an uptick at CPI, Chromology, and Stahl in the last month. Although Stahl and CPI have not yet fully caught up with 2019 levels, Chromology has even registered sales above prior year in certain months. Constantia has been very resilient since the beginning of the year, with no noticeable impact on its sales. We are closely monitoring the impact of the new lockdowns announced a few days ago in multiple countries and hope that the positive trends will continue over the last quarters. In terms of net asset value now, on slide 13, we are reporting a value of 145.3 euros per share, down 12.6% year-to-date. Compared to the latest reported NAV, which was at the end of June, we nevertheless registered a slight increase of 4.9%. As already explained by André, this change has essentially been driven by the increase in value of our unlisted assets, which was of 12%. Within this increase in value, around 60% can be attributed to the increase in listed peers' multiples, and the balance is the result of our companies having adjusted their forecast for 2020, following a better than expected performance in the third quarter. The breakdown of our net asset value as of September 30, presented on slide 14, is very simple. Around 3.1 billion euros of Bureau Veritas, barely up versus June 30, and close to 3.8 billion euros of unlisted assets. Bear in mind that CPI is still valued at its acquisition price in our September 13 NAV, as per our methodology. When including our 1.15 billion euros of cash balance, the total gross value of our assets amounts to 8.1 billion euros, from which we deduct the value of our bonds outstanding, which is 1.5 billion euros, to derive our roughly 6.5 billion euros of net asset value. The implied discount at the end of September was of roughly 44%, an historically high point, in line with some of our peers. Let me now touch base on the topic of CPI's valuation on slide 15. As already explained, our investment is still valued at cost in the September NAV. In compliance with our methodology, this remains so until the first year anniversary of the closing, which occurred on December 31st, 23, last year, for CPI, meaning that we will switch to peer multiples valuation as of the net asset value of December 31st, 2020. Now, given the very specific nature of CPI's business, there are no obvious pure comparable listed companies out there, but we have identified a preliminary list of companies, each displaying similar characteristics in terms of business model at some level that we think would qualify for a proper valuation approach. These companies typically operate in license or subscription-based environments, like training or certification in governance, risk, compliance, services, or data. This analysis is still very preliminary and needs to be finalized and validated, but should CPI's valuation be based on the average multiples of contemplated peers, the total net asset value of Vandal as of September 30 would still have been up slightly versus June 30, taking into account the payment of the dividend which occurred in the interim. As you can see on slide 16, the trend in terms of net asset value since the end of last year has been a tale of two stories. At the end of March, just a few days after lockdowns had been announced in all major countries, stock markets were plummeting, and this combined with the required evolution of the weighting of IHS peers sample and some downward revisions of forecasts for 2020 by some of our portfolio companies, drove our net asset value down to 118.2 euros. Since then, the recovery of the stock markets, combined with improved forecasts for 2020 following the better-than-expected performance in Q3, has led to an increase of our net asset value to 145.3 euros per share. As said previously, the increase in September has mostly been driven by the value of our unlisted assets, while the payment of a 2.8 euros dividend per share that took place early July consequently reduced the value by this very amount. Moving to slide 17, as you know, a lot has happened over the past few years, but the financial profile of Vandal has remained very strong and healthy. As you can see, we have decreased our LTV ratio down to 6.1% starting from 2018 and have remained pretty much in this ballpark since then, despite the impact of the coronavirus and the accelerated portfolio rotation executed over 2019 and 2018. Our net debt has also been quite consistent at around 400 to 500 million euros. I now hand it over to David for an update on our roadmap and our investment strategy.
Thank you, Jérôme. Good afternoon, everyone. David Darmon speaking. I will now describe the group priorities and where we are currently putting our energy on. On slide 19, first and foremost, we are working with our portfolio companies to make sure they adapt to this new environment. Each company went through some kind of reshaping to adjust either their business model or their cost basis. As an illustration, CPI transitioned all its training online and had to design new teaching methodologies to adapt to this crisis. Chromology, for another example, developed significantly its click and collect approach. Beyond protecting the organic growth and the margins, we are also looking at various bolt-on acquisitions. We are selective, but we can see some interesting situations with strong strategic rationale. On the front of new investment, we are selectively looking at some opportunities. As you know, everything is expensive nowadays in the context of a global flight to quality. I will come back on the next slide on our criteria for new investments. Last, we want to globally reposition our group towards higher growth businesses and more favorable CSR trends. That means more focus on situations with high single-digit organic growth and on companies having a positive impact on the planet or the people. I'm turning now on slide 20. Considering our growth and CSR objectives, our investment strategy has been slightly evolving. We will continue to build a somewhat balanced portfolio of public and private assets with a very open-minded approach regarding control. We will always favor a situation where we can have an influence. As discussed previously, we are focusing our efforts on new opportunities with strong growth, and we have resumed our efforts on the Vandal Lab, and we will commit a moderate but growing part of our balance sheet in growth funds and growth situations. In terms of geography, we will narrow our focus to Western Europe and North America. We have recently reviewed our office's footprint to match this new focus. Regarding ESG, we have changed our internal processes to put it at the core of everything we do. ESG is the starting point for opportunity selection with an exclusion list. We also systematically include a CSR due diligence, and we have strong CSR objectives in our 2024 roadmap. And I will touch more on this later on in this presentation. On slide 21, we detail here the grid we follow when looking at new opportunities. You can see a slight evolution. This is not a revolution. ESG and growth have been prioritized, and we continue to focus on high-quality companies led by great management teams. We are looking for companies with most of those attributes that you can see on this slide. Turning to slide 22, for Vandal and all our portfolio companies, we have set up 2023 ESG roadmaps, including objectives and some KPIs we are closely tracking. Several ESG priorities are addressed with special efforts on improved compliance, higher gender balance, and climate change, notably by better monitoring of our CO2 emissions. Vandal took some public commitments, and signed the UN PRI's and France Invest Parity Charter. On slide 23, a few words to show where we stand as of today on those topics. Our efforts are being acknowledged on many fronts. First, on the feminization rate at the holding level. Vandal is a best-in-class among the SBF 120 women in leadership ranking. It's also worth mentioning that the transparency we want to provide to our investors is recognized, and Vandal ranks number 4 out of the SBF 120 index at the Labrador Transparency Awards. Last, we are working with rating agencies to track the progress we make, and we are pleased with the progress we made this year. I will now leave the floor to André for conclusion and look forward to a Q&A session at the end.
Thank you, David. So here are my final remarks. Vandal is well positioned to seize further opportunities. We have a resilient portfolio overall, with significant exposure to companies benefiting from ESG tailwinds. Leverage is conservative. We have a well-prepared roadmap to deploy our capital. We have an opportunity to embed ESG deeply into the firm for competitive advantage. Our organization and portfolio are tight and agile, with strong focus, new leadership, and renewed energy. Thank you for your attention, and now it's time for Q&A.
Thank you. So we will turn now to the Q&A session, which will last 10 to 15 minutes. Remember that you can submit questions in writing on the webcast platform, and I will read them. We will then handle the questions submitted orally by telephone only on the English-speaking line. So the first question from the web. Bureau Veritas is quite big in your portfolio. Could you, in the medium term, reduce your stake in this company?
So first, I'd say it's nice to see Olivier as in CNN being the moderator. So thank you, Olivier, for this first question. We get asked the question about the very large exposure to VV in pretty much any one of our meetings. I understand that coming from an asset management background. It's very atypical constructing a portfolio from bottom up that you would ever have such a large position. Having said that, we have this position. As I said, we think the company has a lot going for it. I'd say in all scenarios that we consider for the future, BV will play a big role in those scenarios.
Thank you. You have another question from the web. Generally speaking, what is your view about the potential impact on your companies of the current lockdowns versus the lockdowns of March and May?
Well, I will start, and David, maybe you want to continue. In most countries we operate, particularly in Europe, where these days, and some others like India and other big markets, the lockdown was extremely severe with effectively a total shutdown of everything but essential activities. As we currently speak, particularly standing here in Paris, as you can see, we continue to work. It's really our social life which has been very significantly reduced, and a number of industries which are audience attracting, traffic generating audiences which have been hit, businesses in retailing, for example. So it would be naive to think that there will be no impact. There will be an impact. We can't quantify it. It's so recent. Every one of our companies is looking at it right now, so it will certainly be factored into our thinking. It will be much more modest, we hope, than what has happened to date. Maybe a general comment before I ask David to add anything he'd like to this, or Jérôme. Effectively, the view here is that we're going to be into this for quite a long time. As you know, the virus has morphed, at least in Europe. So it's now we're chasing a moving target. There are a number of studies showing that you can catch the virus again in its new version. And therefore, we have to think and we have to keep that in mind. It could be with us for many more months. Thank you, David.
I will just add that even if it's difficult to quantify the impact because we don't know the length of this new wave, we don't know if there will be additional waves. But what we know is that our companies are better prepared this time than last time. They have developed new products. They have revised their supply chain. They have made new hirings that were needed for this extraordinary time. So even if it's difficult to quantify, we feel pretty well equipped in all our portfolio companies for what's to come.
Okay, thank you. Would you say that the increase in the valuation of unlisted assets between 30 June and 30 September was largely driven by IHS?
It's a factor, undoubtedly, in this valuation increase, but I can't be more explicit, unfortunately.
Okay. You are not the only holding company with important discount to NAV. What are the main reasons for that important discount? Or how would you grade your visibility on assets, or remaining debt, or the liquidity of your assets?
That's a very difficult one. As I joke sometimes, I started my career back in 1985 at Morgan Stanley, and I visited CGIP, which is today's Vandal, and I lectured them extensively on the discount. There have been high discount moments, low discount moments. Ultimately, we debate this quite a bit in the team. Ultimately, it's supply and demand. I think we have high discounts in moments when there isn't a lot of demand, and therefore the stock price has adjusted to that. In terms of our characteristics, we share this very high discount with others who have very different strategies, whether it's Euraseo, according to some research reports that I've seen, or whether it's Csr, or whether it's FFP, actually has a higher discount than us, to pick a number of our related peers. We clearly have a large stake in BV, which weighs on the discount. We clearly have a somewhat moderate liquidity of our shares, although I think it's enough for many. I don't think it can be. We have holding company costs, which we watch carefully, but not enough to explain a significant discount like this.
I would just add that maybe during downturns, companies like ours see typically the discounts to widen. So it's a natural movement from investors to move away from, I would say, more complicated stories than during upturn.
It tends to adjust. In other words, at some point you basically rebound from the level, and it becomes a very attractive buy because it adds the reduction of the discount to the momentum in the portfolio. And I'd say we feel, rightly or wrongly, it's really you, the investors, and you, the analysts, who need to form these judgments. But you will have noted that we are resuming our share buyback.
Thank you. I have many questions. Some are the same. Any news regarding IHS IPO?
Well, no. Sorry about that.
Okay. When Vandal looks at the ESG characteristic of a potential investment, a bad ESG score will be a no-go or a reason to invest in order to improve ESG and make the investment better?
David? Well, David gets the easy ones. I'm joking because, of course, this is a very profound one.
Well, I think we are proud to work with portfolio companies to improve their ESG rating. So even for companies in our portfolio who don't score where we want them to score, we put as much effort as we can to improve their score. It does not mean that we are pleased or not pleased with where they are. But regarding new companies, we want at least to have companies which are neutral and not having a negative impact. So it's an opportunity, but it could be an opportunity for other investors. We do want to invest in companies which are already focusing and with the mindset of having a positive influence and impact on people.
Yeah, I think we're in the mindset of you don't fight the tape. In other words, there may be improvements to be made, but if you have headwinds, the world is going away from you, and your asset, your company, may be much less desirable going forward, with some people who simply will not even look at it. So we have to bear that in mind.
Okay. The implied write-down in the value of CPI seems large, given the impact on your NAV going from plus 5% to flat. Could you add some color on what peers you will compare it, and what, in general, multiples those companies command?
So I just turned to Jérôme for another easy one here.
Yeah.
Well, first, as I said, the estimate is very preliminary. We haven't yet finalized the list of comparables to be used. We've run a sensitivity based on what we currently know, that is the level of the multiples of the companies that we have identified as potential candidates, the current aggregates of CPI which have been affected by COVID in 2020. When we will switch at the end of the year to the market multiples methodology, we will take into account 2021 budget. We will also finalize the list of comparables, and we will take the then prevailing multiples. So a lot of uncertainties. We thought it would be useful for investors to get a sort of broad estimate at this stage. But this is very preliminary and again, not to be taken for granted.
I'd like to make a few additional comments. One, I don't like bad surprises, so we made the quantification, and we'll be more specific down the road. Two, our methodology includes no control premium, no trading company discount. So when we integrate a company in the portfolio that we have bought in the M&A market, i.e. at a premium, you shouldn't be surprised that oftentimes this translates into an initial negative NAV. Thirdly, in our portfolio, this is one of the companies based on social interaction which has been the most affected. I really don't think they have reacted so well, and you'll be able to tell it from yourselves with listening to Tony, that I don't feel personally that there's substantially value being impaired. But we have a mark-to-market approach, and we need to apply it, and we always do.
Okay, thank you. One last question on the web, and then we will go to the phone question. Can you elaborate a bit on the new strategy for the Vandal Lab?
David? Well, it's not a new strategy. I think we talked about it last year, and what we're saying is that we continue the strategy and we accelerate on it. So we want to be more exposed to the long-term trends we can see in terms of technology and higher growth segments. And so we are looking to deploy more capital, providing capital to some external managers in investing in a sort of fund of funds, so giving money to the best managers out there who can deploy in those companies. And at the same time, for our own benefit and our portfolio companies, we want to get more exposure to these trends and knowledge and create some interactions with our portfolio companies and the portfolio companies of those funds. So it's both investing more and creating more interaction between those investments and our current portfolio companies.
Okay, thank you. So we are moving now to oral question. May I ask the operator to give us the first question by phone, please?
Of course, thank you. Our first question is from Pierre Louvier from Clementine Asset. Please go ahead. Pierre, please ensure that your line is not muted.
So I'm sorry, but
perhaps we move to the next one and then we can come back.
Is there another phone question? Another question? No. Okay, so question asked on the web. With no dividend coming from BV this year, what will be the P&L of the holding company look like in 2020?
Well, there is no impact from the dividend received from BV in terms of P&L. The impact is on the cash flow of Vandal. So having received no dividend in 2020 represented a decrease versus an average year of about 90 million euros, 90. But the fact that we've been reducing very much our financial interest over the past years and having such a strong financial structure puts us in a position to withstand the cut from BV, the dividend cut from BV.
If the question is indirectly, will this affect the dividend next year? the answer is not a key consideration at all.
And a very last question from the web. What are your objectives of new investment in the next 2 years? Have you any figures to give us? Or can you justify to be so much exposed to BVI while diversification is highly required by equity investors?
I think I've addressed the first point, which is obviously the critical point, by saying that it's a historical investment that we have, that we recognize that indeed there is a very significant weighting, that we think it has a lot of headwind, and that we intend to have it play a big role in the portfolio going forward. And the other question, would you like to address the other question, David?
Yeah, I would say that it's not the way we think. Well, we put a number out there and we're going to match the number to deploy capital. We have the means to invest. We talk about our liquidity and the strength of our balance sheet. And if we find attractive opportunities at reasonable, attractive valuation level, we will deploy capital.
The bottom end of the range we've announced in the past was 200 million. The top end, more 700. We're minded to look for opportunities which are closer to the bottom end of the range or the bottom half of the range.
So, thank you very much. We must now turn to the next presentation. We would now like to welcome Loïc Derrien, CEO of Chromology, who will present his company from his locations in Clichy, France. After the jingle, there will be a short introduction by André, and then the presentation itself. Please launch the jingle.
Well, it's a great relief to have seen your picture, Loïc, and to see that the connection seems to have worked. We'll shortly have the proof in the pudding. So I'm very happy to introduce Loïc. Just a quick reminder on Chromology itself. Chromology is one of the leaders in decorative paints, a market which is resilient. Chromology operates in a number of jurisdictions, mainly in Southern Europe, but not only in Southern Europe. And it has strong brands. Loïc has been leading a turnaround of Chromology, which is what's left of the Materis acquisition many years ago. And he joined us a little over a year and a half ago from PPG, where he was one of the senior leaders. He was responsible in particular for the decorative paints business in Europe, Middle East, and Africa. And together with Pierre Pouletti, who is the chairman, it's a very dynamic duo which has considerable achievements to their credit already. And Loïc, the floor is now yours, and welcome.
Good afternoon, André. Good afternoon, everyone. Thank you for having me. It's great to be here. I'll start with a quick overview on the company, and just to say that obviously we are a paint manufacturer. That means that we are designing, producing, and distributing a wide range of paints, but also decorative product that we mostly sell through our captive networks. 70% of our business is made out of paint, and 30% out of this good for resales, again, mostly sold from our captive network. We are a leading player in Southern Europe with an average segment share of 10%. We leverage our very strong portfolio of local brands to go to market with our integrated stores for 60% of our sales, but also independent and DIY distribution networks. 65% of our business comes from France and 35% from Southern Europe, but also Morocco, Switzerland, and also a bit of export activity. In this business, we are mostly exposed to renovation and a little bit less, only less than 20% to new construction, which makes us a very resilient business in general. Moving to the next slide, please. So how did we react or were impacted by the COVID-19 situation? First of all, we had to readily adapt to the lockdown on an ad hoc basis because depending on the country, we either had to go through a full shutdown for 2 weeks in France, for instance, and Switzerland, to partial or no shutdown at all, like in Portugal. March and April were basically half of a normal months, so there was a significant impact on our business, but we were fortunate enough to see a bounce back as of mid-May. The pattern that we faced across all our geography was quite similar. First of all, we saw a recovery of our independent channels. They restarted first, then integrated stores as we progressively reopened them, and then finally DIY distribution. The demand from DIYers was extremely strong from the very beginning as stores reopened, and we saw a more progressive resuming of the activity of the professional painters who actually faced more difficulty in operating given the new safety environment. Our top priorities as a company during the crisis was definitely health and safety for our customers, for our people as well, of course, and our partners. Compliance with the demand of regulations, the demands and regulation from the local authorities, and also, preserving the customer relationships, even though from a distance, or also our business and company assets. Moving on to the next slide, please. Thank you. So, what is it we did during these times to adapt to the situation? First of all, we basically had to reinvent the way we are operating, from plant to stores, with new hygiene protocols, with new team organization, obviously a home office, but also new customer-facing rules when it comes to meeting our customers either on site or from our stores. We adapted our processes in plant and store to remain productive because at first we were definitely impacted by that. We had to set up new communication and management routines because it was critical that we remain with high morale, across the company and keeping a strong link with management, but also through regular communication or with Works Council was actually critical for us. Also, we learned on how to maintain customer relationship from a distance. So, as I said, it was a new practice for us. Then we had to work a lot on our digital platforms or IT platforms. So, first of all, we had to leverage and enhance our existing B2B e-commerce websites, mostly in France, where we had already some experience there with click and collect. Then we launched in less than 4 weeks 2 B2C websites, also in France. And further along the way, we introduced new digital color selection tools and color samples delivery because, it's critical in the buying process of paint that you are confident that the color you choose is actually the right one. And being able to do it from your couch, basically, is essential. Our IT teams have been extremely active. Obviously, I'd say 2 major achievements was to set up in a record time the e-learning platform that we had in the pipeline, but also our e-recruitment platforms because we did hire people during the crisis. We had to we took the opportunity of this period to invest heavily in sales skills and sales management skills, even though via e-learning. We, for instance, worked a lot on our pricing discipline in our stores through this program. And we also had to move production across plants and countries to face demand peaks because it was extremely erratic over the past months, and we had to face some instant capacity issue given the strong demand peaks. Moving on to the next one, please. So that's the financial. You can see on the left top hand side the sales where you see the drop in March and April and the recovery starting May, and definitely since June we've been above last year, month after month. We had a strong rebound of demand, but also a very favorable customer and product mix. We implemented immediately contingency costs and also continued on our structural action to decrease our cost base. So end of the day, the H1 for us is a 40.4 million EBITDA, which is an 8% increase versus last year, and it's a 320 base point margin year on year, which is obviously good news given the circumstances. Of our cash flow conversion rate ratio was 65% over the period, so that meant for us that we were able to stabilize our debt and slightly improve our debt on EBITDA ratio. Moving on to the next slide, please. So what's coming next? In the near future, we do expect that demand remains bumpy in all geography, given that we see some outbreaks popping up here and there, especially in France at the moment. On the good news, I'd say home improvement remains high in the agenda of consumers and many people, given that there is less money to spend in traveling and other type of leisure. So I would definitely recommend to everyone listening to use paint as a way to relax and improve their home. The next month's focus for Chromology are going to be around the same line as what we've done over the past months. Definitely making sure that we operate safely, because we do see some more cases of COVID sick leave in our team, even though we managed them pretty well so far. We are still executing on our transformation program and reduction of non-value adding cost. We have already, and we will allocate more sales and marketing resources to the promising segments, because you have to be extremely flexible in the current circumstances to address the segments that are performing better than the others. We'll keep on investing in our digital capabilities, not only on the front lines where we still have a lot to do, but also all along the supply chain where we have some improvement to make. We'll beef up our product development activities, especially in the field of eco-friendly products, if I can call them like this. And finally, we're currently looking, and we'll look on bolt-on acquisitions in Europe. Moving on to the next one, please. Obviously, more than ever, CSR is key for Chromology as a company, but I would say for Chromology as a team. We've worked during the period on our CSR priorities, and you see on the left-hand side of the chart the 5 building blocks that we've chosen to focus on. We will definitely keep on acting upon those priorities in the coming months and years, so as to deliver on our mission that you see on the right-hand side of the slide in a responsible way with respect to all stakeholders and also the planet, I would say. Moving on to the next slide. So key takeaways. First of all, the good news is that we've managed to improve our EBITDA in value and margin in a very tough environment. We've benefited definitely from a rebound from the end-user demand, but also strong price discipline and tight cost management. On the cash flow generation side, we did improve it as well, thanks to our improvement in profitability. But I'd like to recognize a very strong performance of the sales and finance team on account receivables and inventory, which are critical in our business and especially in tough times. And they've managed to steer them to a high level of excellence. Working on cost, as I mentioned a couple of times already, has been key, and we've seen everyone reacting extremely fast to the situation internally. So we have done that on a very ad hoc basis, but also on a more structural way, because we have kept on implementing our structural cost reduction initiatives as they were planned in our business plan. Looking at the future, definitely we have refocused our supply chain, marketing and sales efforts on the key topic or hot topics to secure our top line. So that's safe working and shopping. It's very basic, but it's actually, being safe at work, providing a safe shopping environment is actually critical for both employees and customer at the moment. Product availability is critical. The new digital channel ramp up with e-commerce, click and collect, digital color tools, as I mentioned, and we have more to do there and more coming in our pipeline. More than ever, I think we have acted in line with our health and safety values during the crisis, and both customers, but even more employees have recognized how well we have made sure that they were safe at work, and we get really the benefit of this in our current team motivation and commitment. Our CSR priorities are clear, and we work on them since some time, and even more focused as they are clarified to everyone. Moving forward, I'm happy to report that we are ahead of our BP business plan, thanks to the highly engaged team I just mentioned, and we are now working on the next phase of Cromology transformation towards more profitability even and more action. With that, Olivier, maybe we'll take a few questions.
Yeah. It's no time for questions. So once again, you can submit your question through the webcast platform or via the dedicated telephone line in English only. So I will start with the first question from the web. Can you share your expectations regarding the impact of new lockdowns in Europe on your business?
Okay, that's a tough one. I'd say in France at the moment we are lucky that current French rules or regulation allow us to run our factories as well as our shops. So painters are so far, authorized to work, and our distribution channels are considered as a wholesale, which enable us to operate almost in normal condition. And we can also offer, paint to DIYers as long as they use the click and collect and or the DIY shops. The week before the lockdown, we actually have seen a strong activity in our stores. So October has been a good month, and the first days of November are fairly reasonable. So we face no specific problems in our supply chain at the moment. So I would say we look very cautiously, but I wouldn't say optimistic, not being too optimistic, but we see a reasonable trend as we speak. And last but not least, November and December are kind of low seasonality months for us, so we are less exposed in these months than we were in July, for instance.
Thank you. To what extent are bolt-on acquisitions value creative? Can you elaborate a bit on the targets you are looking for? Which countries, which segments? Any assets up for grab at the moment?
That's a very confidential question. I'd say we've cleaned the house, and I'd say where we operate, we do have strong business with strong teams and stronger and stronger operating discipline and software. So I would say with that, we are ready to look for acquisition in markets where we are strong. That could be France, that could be Italy, Spain or Portugal, because most of these markets are still highly fragmented, especially Italy, Spain as well. There are targets that we discuss with at the moment in various geographies, and they will, however, remain in the field of our deco specialty, because that's where we like to operate at the moment. And if any interesting opportunity could pop up in Northern Europe, why not going there as well? I'd say when it comes to why should we do that to create value, it's definitely a scale effect that you get out of that, and being able to help companies operating under the normal performance of a deco business to raise their bar in terms of performance. That's what we can bring to acquisitions.
Thank you. Another question. Can you describe the non-financial help you receive from Vandal?
non-financial help. We get a lot of support from Wendel because I'd say it starts with the board that we meet on a monthly basis. We have all sort of committees, audit committees that help us operate to always taking us to the next level of excellence. I would say we definitely get a lot of help when it comes to acquisitions because that's definitely topics that we discuss with the Vandal team. And Vandal is a very well-respected company in France and in Europe. And I would say, just the fact of being part of the Vandal family is for our employees and for our partners a very strong asset.
Thank you. Could you please elaborate on e-commerce in your industry?
Yes, e-commerce. We kind of we tend to be an old-fashioned industry in many ways, but we've seen this changing rapidly, over the last few years. So e-commerce means for us being able to provide the same service as we do in our stores from a web platform. So that can materialize as a sales through our store websites, but it also can be through the platforms of our big customers and distributors like Leroy Merlin or Castorama, and soon Amazon. There was, in the past some difficulty of shipping paint rapidly to the end consumer or even the professional painters, but this has been addressed in the industry and as well at Chromology.
Okay, it seems we have absolutely no question by phone, so a very last question from the web. Who are your minority shareholders?
I'd say I'm part of them. And so there is definitely, the management team as our minority shareholders, plus some shareholders that were, along with Wendel for a long time, and the Materis deal.
Thank you. So the time allotted for the question has now expired. We must now turn to the next presentation. We now welcome Huub van Beijeren, CEO of Stahl, who will present his company from his location in Waalwijk, Netherlands. After the jingle, there will be a short introduction by André-François Poncet, and then the presentation itself. So please launch the jingle.
Now moving to Stahl. Stahl is an outstanding company, which we like very much and has been part of our portfolio for a long time. Stahl is a leader and a market consolidator. It generates a lot of cash flow, and it still has a lot of opportunities ahead. Right now, times are difficult, especially in the current sanitary and economic crisis, but management led by Huub has been very reactive. The Ebitda margin has been preserved thanks to a strong focus. Huub is a regular at the Wendel Investor Day, but for those who are attending for the first time, he has been Stahl's Chief Executive Officer since 2007. He's led the company through the financial crisis. He has succeeded in making Stahl the world market leader in surface treatment and coating solutions for a wide variety of materials. Huub, it's a great pleasure to have you now, I beg your pardon, and the floor is yours.
Thank you very much, André. And I would like to take the opportunity to say to everybody, welcome to Waalwijk, because you're here in Holland. And I would also like to take the opportunity to thank you all, because you're all customers of Stahl. You are indirectly using all kinds of components that Stahl is providing to our customers. So you buy cars, you buy shoes, you buy all kinds of sorts of things in houses that hold style materials. So thanks for that. And the second ones I want to thank is the people of Stahl, because they have done a fantastic job in bringing Stahl where it is at the moment through the crisis. And I think that also deserves a very big thank you from us. So thanks for that. And now moving to the presentation, yes, Stahl is the world market leader in surface treatment and coating solutions for flexible materials. We are the leader in responsible chemistry. 2019, we had 809 million sales, and we had a percentage of EBITDA margin of 22.6. Our biggest part of the turnover is leather chemicals, as you know, which is counting for about 2/3 of the turnover, and the rest is what we call performance coatings, which is non-leather. Sales per region were well spread over the world. We have about 40% in Asia, 36% in EMEA, and 26% in the Americas. And we have a diverse portfolio if it comes to the end applications. Many everyday materials you're using, and they are having coatings. And those coatings are being put on there to enhance the properties of the products for all sorts of reasons. They last longer, they're softer, they're better resistant. All those kind of items are very, very important for coating. Next slide, please. So, okay, we had a very good start of the year. Q1 was good, apart from the sales in China, of course, in February and March, they were already down. But overall, we had a very good quarter. And then, 45% less sales in the second quarter. That was heavy. I tell you, it's smack in the face. It came there, and of course we were reacting immediately. And again, and that's why I'm thinking the quality of the people of Stahl has made us, I think very resilient in this crisis that we had to face. And we were, I think, very active in taking all kinds of measures. If it comes to taking measures, Stahl, I think, always has been very reactive and responsive if it came to difficulties. So I think we immediately said, listen, let's have our Cmc philosophy. And the Cmc philosophy is cost, margin, and cash. In a market like this, when really your customers are canceling orders, and we had many days that we had more cancellations of orders than incoming orders, then it doesn't bring you so much to go to your customers and ask if they want to buy more from you. You cannot really influence that. But what you can influence is, of course, the things that you can really have a handle on, and that is cost. So I think that we were good at already, and we did again. I think we went, as I said, we went to the Weight Watchers on the costing side. We were also concentrating on the margins, keep the margins at a high level, and I think we survived in that, and we did very, very well. And then apart from that, we thought, well, cash is king, let's concentrate on cash. And I think we did well over there. And in fact, what we did is reduce the debt with 100 million by good working capital management, all the usual things that you have to do. CapEx, were very, very slim. So I think that also led to the situation that our underlying EBITDA margin stayed basically the same, at the same type of level. So I think that entrepreneurial spirit that you always have in Stahl, which is embedded in the DNA of Stahl people, I think has brought us till we were now. Because gradually, after the second quarter, the sales started to increase again. The customers were coming back. They were getting orders. And you saw an improvement of the order book, a constant improvement of the order book, leading in September, October, to levels of sales close to last year. That means also, of course, that the bottom line with cost control, good margins, that makes then also that your bottom line is going gradually better. And it's at a very good level at the moment. Okay, say the recovery was starting quickly in China already, and in China we're really making record months, so it is better than last year, far better than last year, and also the polymer divisions did a very good job worldwide. Next slide, please. Okay, new ways of working with customers. Well, listen, as you all know, Stahl always had an enormous intimate relationship with its customers. We have 600 technicians, we call the golden hand, and salespeople working with customers. And that had to change. That had to change because they couldn't travel anymore. So we were really accelerating our engagement if it came to the digital side of things. Really, digital got traction at Stahl because of this. We were working on digital, but it really got at a very, very high professional level because of the COVID situation. We had to talk to our customers. We had to talk to the brands. We had to talk to the automotive industry. We had to talk to the NGOs. And we did that. And I think we lifted it at a very good professional level. What we also did, we kept supplying because a customer who again gets orders wants to supply quickly, be supplied quickly. And I think that is what we did. We also improved our ESG performance and also helped our customers to do the same thing, because we have many customers who talking about it, but I think they need help, and I think we did. We also helped them on the technical applications of things through our studios that we have, our technical centers. And we were regularly sending newsletters, organizing webinars and things like that. And at the same time, I think really Stahl origin, keeping 2 feet on the ground and executing on your Cmc philosophy, cost, margin, and cash. Next slide, please. Okay, and I think we also did understand that, you go into a crisis as everybody else. Nobody can help it. But at the same time, you go into a crisis, I think you should already realize, how do you want to get out? You want to get out stronger than your competitors. You want your relative position to improve. And I think that is what we immediately also wanted to do. So we accelerated all kinds of initiatives that were already being taken earlier, like open innovation. I think now we have an innovation officer at the management team. So I think that is very important, with a team of people driving open innovation, working with partners, working with universities, working with suppliers, leveraging on the knowledge that Stahl has and other people have, and combining that. Digital transformation, major impact on the company, as I said already. Renewable carbon feedstocks. Well, we're driving processes to make sure that we are not dependent if it comes to fossil fuels, because there's an end to it, and we have to steer the company in different ways. So we are working on natural resources, biotechnical feedstocks, those kind of things we're working on, I think, in a very concentrated way. And then, of course, ESG is in our DNA, and I think we are working on that very strongly. So, next one was that luckily we have a very strong regional organization. I think we benefited from that a lot. Think global and act local is in the DNA of Stahl and is making the company strong, whilst some of our competitors are very centrally led, whilst we give a lot of, I think, responsibility and opportunities to our local organization. For instance, in Brazil and in China, we have very strong organization, and that goes for all, I think, for all the regions that we have in the world. And then we also launched a Chinese website, a real Chinese website, because the normal Stahl website was very difficult to access in China. So we built one in China. It is really a Chinese one. Next slide, please. Monthly sales, you see it, the big dip was in the second quarter. We close to last year's levels again, so that's good, as I told you. EBITDA level, margin was protected, so we stayed at a very good level, I think. Leverage staying at the same level. And I think it shows a resilient business. A resilient business. Next slide, please. Expanding Stahl's leadership on ESG. Yes, I think ESG has been already for several years been very important for Stahl. So we have concrete commitments if it comes to the years to come. We want to do the things better and better. I think that is in the way we operate. So we can I think do things a lot more professional by really concentrating on them. So if it comes to the ESG reporting and compliance, I think it's important also that we are I think have really a team concentrating on the progress that we made. So we have our goals, and I think if it comes to the progress, it is also being measured. The duty of care, EFPD, which stands for Extra Financial Performance Declaration. That is an ESG legislation which is for listed companies, but since Stahl, of course, is part of Wendel, we are doing those kind of things, and I think we take it very seriously. Yeah, and we constantly are upgrading the Stahl ESG annual report. Next slide, please. The takeaways. Okay, we took swift action and strong focus on cost, margin, and cash. The quality of our people helped us through this whole crisis. New ways of working, we've spoken about it, with our customers, and it has strengthened Stahl's business model. We have a very strong regional setup, and that means strong relationship with our customers in the different regions. We have established an ESG roadmap, and there's clear commitments that we have, and they are measurable. And of course, the conditions at the moment are unclear. Nobody knows what's going to happen. And it's getting worse in Europe if it comes to COVID. But I think we have shown that we have a very strong organization to face the challenges, even if they would come back. So, thank you very much for that. That was the last slide, I think.
Yeah. Thank you very much, Hib. So time for Q&A now. Once again, you can submit your question in writing via the webcast platform or by phone, but via the English line only. So the first question from the web. You are quite exposed to Chinese ASEAN markets. Can you give us more insight to what is going there for you?
Yes, very good question. Thanks very much for that. China is a very important country. Of course, we have a production location. We have a full-fledged organization over there with a very good management. We've been very successful in the last, say, 5-6 months after the COVID crisis over there. I think the market has improved enormously. As I said, we're making record turnover at the moment in China, and that is based on the internal market for a big part. So we've been really successful not only in the automotive industry but also in all kinds of other industries. So happy with China, and I would like them to grow to keep on growing. If it comes to the rest of Asia, that part of the world has been more difficult because they were far more, say, exposed to export markets like Europe and the US. But at the moment, in the last couple of months, it's increasing. And again, last month, we had a record month in the rest of Asia. So things are improving there because also the demand from the export markets are coming back.
Thank you. Could you give example on how you support your clients on improving their ESG performance?
Yes, indeed, we can. We have very good customers, and we have big customers, big multinationals who are doing all kinds of things on their own. Of course, they have a full staff, but we also have middle-sized family type of businesses who sometimes need some help if it comes, for instance, to sustainability. And we have a lot of experience. We have our technical centers where we educate people, and also on the part of sustainability. and that is very well appreciated by the customers, they can send up their people to us, not at the moment, but that's what normally happens. And there, I think we do a lot of good by helping them to get further on the road to sustainability.
Thank you. So Stahl has historically grown through large acquisition, Clariant, BASF. What are the future growth drivers for your company, and what growth rate can be expected over the medium term?
Yeah, always difficult because indeed we had a couple of very good and big successful acquisitions. Very happy with that. But always difficult to time things because we want to create value and we don't want to destroy value. And that makes you, of course, critical if it comes to the opportunities. We, of course, are looking into the market. I think we're busy with several things, but it is a matter of timing if those kind of things are coming to fruition. So there I cannot really tell you if that's going to go quickly or that we have to have a little bit of patience, but definitely with the help of Wendel, we're always, I think, very active to look for the right opportunities.
Thank you. What cost have you been able to cut to weather the downturn? How many million euros saved? What did a one-off impact in 2020, or will these efforts structurally benefit next year's earnings? And same question for working capital.
Rob? Okay. If it comes to cost, our fixed costs are at the moment around 10% lower than last year. I think, yes, there we took swift action. I always say, yeah, we went to the Weight Watchers. Will that cost increase? I think activity levels are indeed growing. So I've signed a lot of application forms to take people in. Because, when we had to cut costs, of course, also some of the flexible shell of the company of say, temporary people went. Now we're taking people in again because our order books are growing. That will mean that the cost level will grow a bit. However, Stahl will not start working at the same type of level that we did in the past. I think we will not go back to the same type of traveling. That means that travel costs will stay at a lower level. So I'm sure that, yes, costs will increase a bit again, but still I think they will be operating at a lower level than we did before.
Thank you. There are a lot of questions on the web. We won't be able to answer everything, but we will call back people. Do not worry. One last question on the web, and then we will go to the phone. So your Ebitda margin is no longer improving since 2016. Can you explain?
Well, if I'm looking at the levels, I think what you need, of course, is again you need a boost in turnover. So that means if our turnover, and that will be growing again, I think that with the levels of costs that we have at the moment, with an increased turnover, I think our EBITDA levels will be growing for sure.
Thank you. So I think we are going to try a question by phone. May I ask the operator to give us the question by phone, please?
Yes, thank you. Ladies and gentlemen, if you wish to ask a question by phone, please press star 1. Our first question is from Geoffroy Michelet from Oddo. Please go ahead.
Hello, thank you for taking my question. I was just wondering if you could give us some insight on or some data that you may have regarding competition and potential market share wins that you may have. I was also wondering to what extent they were able to rebound as much as you did recently. Thank you very much.
Say the exact figures over here. What I can tell you is that we strongly have indications that our market share with the bounce back in sales have grown. I think the advantage that we have, and I explained that a little bit already, we have a regional organization which is very, very strong. Several of our competitors have a very centralized organization, They have some sales offices throughout the world. They have some distributors, and that makes it far more difficult for them to really have the contact with the customer and supply immediately what the customer needs in the situation that we are in. So as far as we can see it, I think we have increased our market share and we're better off than before. So that's what I can tell you at the moment.
Many thanks, Joop, for your time. I'm sorry, but the time allotted for the question has now expired. We must now turn to the next presentation. We would like now to welcome Pim Vervaat, CEO of Constantia Flexibles, who will present his company from his today's location in Oosterbeek in the Netherlands. After the jingle, there will be again a short introduction by David Darmon, and then the presentation itself. Please launch the jingle.
Thank you very much, Hub, for this very good presentation. It's now my pleasure to briefly introduce Constantia Flexibles and its new CEO, Pim Vervaat. Constantia Flexibles, as you know, is a global leader in flexible packaging for consumer and pharmaceutical industries. Vandal initially invested in 2015 in the company alongside the founding family and had been through various reorganizations, recentering itself around flexible packaging with the divestiture of the label division. So today, it's 100% focused on flexible packaging, and it is the number 2 in Europe and 3 worldwide. Constantia activity has been resilient throughout the COVID-19 crisis, and Pim will elaborate about all the actions taken to address those exceptional conditions. This session with Pim is the first opportunity for Vandal stakeholders to hear and ask questions to Constantia's new CEO. Pim was appointed in July with the clear mission to regain competitive strengths by improving operational efficiency in the context of a highly competitive environment, in particular through investments in sustainability projects, a major focus for Constantia and its customers. Pim has a very broad experience in international manufacturing industries, either in public companies or in the private equity world. Prior to Constantia Flexible, he was CFO and thereafter appointed CEO of RPC Group, a global design and engineering business in plastic products with a great focus on packaging. During his mandate, the company achieved a TSR of close to 200% and quadrupled sales to around 4 billion euros. Pim is also a board member of Avon Ruber and Luceco, confirming its broad experience across industrial and manufacturing goods. We are very happy Pim Vervaat joined Constantia, especially in those times of economic crisis and operational challenges. Pim, the floor is yours.
Thank you very much, David, for that introduction. I'm delighted to join the Constantia Group and very much looking forward together with the team to further develop the strategy and indeed to implement it successfully. Next slide, please. So here you can see our business model, a very high level. It's a global leader in flexible packaging. It's in all substrates, so that means both aluminium as well as in foil as paper. 64% of our sales are in Europe. Outside of Europe, 36%, and we have a leading position. We're number 3 in India, which is one of the fastest growing markets. Blue chip customers, as you can see on the right-hand side, and 2 business segments, 78% is in consumer, 22% is in pharma. Around 1.5 billion of sales with 11.5% Ebitda margins achieved last year. Next slide, please. Can we have the next slide? There we go. So some general comments impacting the company with respect to COVID-19. The first 9 months of sales, we've grown organically about 0.5%. It's reflecting a strong performance in pharma, which is almost up 10%. It's offset by a modest decline in the consumer areas due to lockdown measures in the emerging markets, in particular India, South Africa, and Mexico. The peak in consumptions at the end of Q3 from European consumer businesses, which have benefited from an increase in the at-home food consumption, was not sufficient to offset the difficulties in the emerging markets. Ebitda at the end of June up 5% at 97 million, driven by various cost reductions initiatives, but also by lower raw material prices. They will be passed on to the consumers, but it takes around 3 to 6 months. So we are benefiting temporarily over the last 6 to 9 months from that drop in raw material prices. From a business point of view, you can see that we've benefited from the essential nature of our products, both in pharma and in food. So we've showed resilience in a volatile market, as we all know. And the Ecolam sustainability technology, which has superior recyclability to its alternatives, was rolled out in November in India. Factory started up. It's a market which is also very conscious about sustainability, but due to the COVID-19 situation, lots of the testing and trials with customers have been delayed, as you can imagine. With respect to the organization, we're taking great care of our employees. All kinds of safety measures are taken in place, both at the plants and in the offices. And so far, in terms of ensuring continued production, we have seen no disruption. Also, of course, we rely on our supply chain for uninterrupted supply of the raw materials, and indeed we've been successful in keeping that going. So overall, I would say a very good effort from all the Constantia's employees. Next slide, please. So the measures, which are pretty common probably amongst lots of companies we've implemented, is temperature checks prior to entering the factories, additional disinfection measures, social distancing, self-isolation where necessary in case of suspicious cases, and home office for white-collar staff as much as possible. The regulatory monitoring of the supply chain, of course, is also very important, and so far as previously mentioned, we've seen no disruption to productions. And the biggest areas of concern, apart from the second wave in Europe, are indeed India, South Africa, USA and Mexico. Next slide, please. So here you can see numbers. The monthly sales, you can just see the resilience throughout the crisis from the sales graph. Very good situation. The EBITDA improved in the first half year, as earlier reported, to around 97 million, 12.7%. Pleased to report that the EBITDA also improved further compared to prior year in the third quarter. You can see the net debt leverage remained very resilient at a good level, so there's no issue in terms of the financial position. It is a capex intensive activity, but I do think going forward there are potentials for further working capital optimization. Next slide, please. So I've been in the business since 1st of July, so a little over 4 months. I've had the opportunity to do a full review of the business in that time. Of course, I can rely on earlier experience in the packaging industry, where I've been active for around 13 years. General observation is good, experienced teams at all levels, eager to perform. Morale, however, could be improved, and the organization has become a bit too complex. Stuck in the middle, I would call it like that. So the new operational model that we've implemented actually last Sunday, so 1st of November, has now 4 divisions. The pharma divisions as previously, and 3 new consumer divisions. We've reduced the headquarter overheads quite significantly and improved agility, so faster decision making, closer to the customer. The executive committee has been enlarged because we are flattening the organization structure. Again, we want to be decisive. The new strategy we have been working on with the team is called Vision 2025, is under preparation. I expect it to see the light of day externally early in the next year. And basically, it's giving us a strategic framework as to where to play, how to allocate our capital. So that's to come. Next slide, please. Sustainability, key, as you will have heard from all the other companies that have come before me. It's a key market differentiator. We have pledged that 100% of our consumer and pharma packaging will be recyclable by 2025. It will have a transformative impact on our industry, particularly in plastic film, so we take the topic extremely serious. We see ourselves in a potential leading position compared to competition because our Ecolam product has superior recyclability, as mentioned before, so we can build on this and develop. And on the right-hand side of the slide, you can see we're actually very good in terms of getting recognition for our efforts on the Carbon Disclosure Project and also on a number of other ESG activities. So we take pride in that. We get recognized for that, but it's a continuing story, and we continue to further develop the ESG story for Constantia. Next slide, please. So, key takeaways, a very resilient performance in light of the COVID-19 pandemic, innovative ESG strategy, well recognized externally, with the new monomaterial Ecolam and the green strategy really putting us in a good position in the transformation that you will see in the packaging industry over the next 5 to 10 years. Good cost control has been put in place, contingency measures to react to the COVID-19. We had a tailwind from falling raw materials, as mentioned previously, which is likely to unwind, though, in 2021. New operational model is implemented, effective 1st of November. There have been delays in Ecolam product, partly due to the COVID-19 issues in India, but we've got confidence of this product really taking market share and helping us in the transformation in the industry. New management team is in place, so we're looking forward to returning Constantia Flexibles to a more profitable growth path going forward, and indeed hitting expectations. I think that was the last slide, so it's time for Q&A.
Yes, indeed, time for Q&A. Once again, you can submit your question in writing through the webcast platform or via the dedicated telephone line, via the English line only once again. So the first question from the web is, during the first lockdown wave, South Africa and India have been more impacted than other regions. What do you see now?
We see the market recovering in the second half. We actually had in South Africa very good months the last month, so it is improving. India as well, although you can see that Diwali, which is a big festivities in India, it's a little bit less than it was last year because people cannot gather in large amounts of people. Having said that, there is recovery in the second half of the year and things start to normalize.
Thank you. Since you joined Constantia, what are the strengths and weaknesses you identified?
I think there's a very good team, lots of good technically able people. Customers very much respect what Constantia can do for them. So I think that's one. Good people, good market position, good standing with the customers. One of the weaknesses, as I said earlier, the organization was a little bit stuck in the middle with no clear focus as to where to go next. And I think we are now in a position with the new management team to be more flexible, more agile, more cost effective, moving forward. And indeed, going through the portfolio, where are we good, where are we perhaps not so good, fix it and move forward.
Thank you. Is Constantia working on biodegradable packaging solutions?
We're working on a number of opportunities. Biodegradable is one of them. It is in the filmmaking, although we have to say we buy significantly most of our film from third-party suppliers where we have cooperation with them. We do extrude in India, we do extrude some in Europe. It's part of the solution. It's part of the many solutions, though. And I believe that particularly in Constantia being a flexible packaging, so meaning all substrates. It's paper, it's aluminium foil, it's plastic film. will give us an advantage. And part of our substrate could indeed be biodegradable.
Thank you. How much margin improvement do you think we can expect over the next few years in Constantia relative to the 11.5% EBITDA margin in 2019?
Yeah, I think if you look at where competition is at of similar scale, these margins will be improved. It's also always a matter of how quick can you get there. But we are in the process in the Vision 2020 strategy to identify what kind of levels we can expect going forward. We are not yet there definitively, and we need to discuss this with Wendel to be honest. But I would say at this moment in time we should at least be able to achieve an EBITDA margin across the group consolidated of 14%, 1-4.
Thank you. You said you saw several areas of improvement at Constantia Flexibles. Can you please elaborate with more example besides working capital?
Yeah, working capital is one. I think the structural cost in the head office is another one. So we have taken the new organization model with some significant savings in the head office. If you look further, we have some improvement opportunities in purchasing, which I think is quite key. In order to improve purchasing, you need to have operational flexibility so you can switch more your supplier base. I think that's going to be one of the key focus going forward. The M&A, which in packaging, I always say you either consolidate or you will be consolidated at some stage. Constantia is a good buy and build platform. M&A record has been relatively spotty in the last 5 years, and that's another area where we can improve going forward.
Okay, another question. Is the raw material positive price impact sustainable in your view?
I think we have to recognize that in 2020 we had the advantage of the time lag that I mentioned previously. So the significant price reduction beginning of the year, which gets passed through to the customer after 3 to 6 months. When it then stabilizes, then we don't have that advantage. So it is likely to unwind. Of course, we'll do whatever we can through other measures to improve margins, but I think that one is just a feature of the industry. Raw materials represent around 55% of our sales, so it's good that we have to pass through. Sometimes we win, sometimes we lose. We won in 2020.
Okay, one very last question from the web. Given your quite good financial situation, can we expect external growth in the near future, and what kind of targets would you look at?
As I said previously, you either consolidate or you get consolidated. I think Constantia is a good buy and build platform. We are in the process of determining exactly which areas to play. So it's part of the review of the Vision 2025 strategy. So I will pause on that and I will come back to you once we finalized our strategy.
And one very last question from the web. Pim, what have been your first operational decisions since you joined Constantia, and how much the year-to-date performance will be improved by all your first 100 days? What is your view and strategy for Constantia in terms of gender balance, ESG, and digitalization?
Okay. To start with the last, I mean, I think in the packaging industry we need more diversity. It's an industry, it's a lot of industrial, it's very conservative, so we will be working proactively to increase the diversity. On the ESG, we continue our march going forward. In terms of improving in the first 100 days, I think we got a very good team within Constantia, and for me it's really a pleasure to work with key people and put them in the right position. I think there was already a good team previously. There were doing the right stuff, as demonstrated, you can see in the first half of 2020 in the resilience they've shown in light of the COVID-19. So I think my contribution the first 100 days is putting people in the right position with the right focus. And one of those focuses, which should really come through in the coming years, is on the purchasing side of things. So I think I've missed perhaps one or two elements of the question. There was a lot of questions in one, Olivier.
ESG digital.
Digital. Yeah, digital is going to be quite a key, as it is for all industries. We've got a good IT team. Customers increasingly are looking towards that. Nothing specific out there, I would say, to the packaging sector. It's going to be part of the future. We're well prepared. We're trying to take advantage of new channels.
Many thanks, Pim, for your time. We must now turn to the next presentation, Crisis Prevention Institute, which will be presented by the company's CEO, Tony Jace, who is joining us from Milwaukee, Wisconsin. He will be accompanied by Adam Rainman, the CEO of Vandal North America, who is located on the East Coast. After the jingle, there will be a short introduction by Adam, and then the presentation itself. Please launch the jingle.
Thanks, Olivier, and thank you, Pim, for that great presentation, and welcome to the Vandal family. Good afternoon, everyone. Just to remind you of the original transaction, Wendel acquired CPI in December 2019 for $910 million, including $569 million in invested equity from Vandal. As this is the first time we're presenting to the group, we wanted to just remind you of the original investment thesis. Now, we were attracted to this opportunity for a few reasons. First, CPI is the leader in a large and growing market providing services to reduce violence in the workplace. Over its 40-year history, the company played an important role in reducing such incidents and established a very strong brand and loyal group of highly engaged customers that Tony will speak about in a moment. Second, the company's business model has historically been quite resilient, supported by a large and growing installed base, regular renewal requirements, high customer retention, and a regulatory mandate for de-escalation training in hospitals and school settings, which collectively represent more than 80% of the company's revenues. Through its train-the-trainer model, CPI has more than 36,000 certified instructors and 1.4 million of their colleagues who are required to renew annually or biannually, creating a recurring revenue stream that increases each year as the company grows. These dynamics produce an attractive financial profile with 40+% Ebitda margins and good free cash flow. Third, we think the market for CPI is substantial. The rise of workplace violence and behavioral health challenges is an unfortunately growing and underserved global phenomenon that is driving the need for CPI's services in the U.S. and internationally. We think this presents several long-term growth opportunities, including introducing new programs, investing in digitalization, and expanding into adjacent industries and geographies, many of which we have already begun working on with Tony and his team. Last, CPI's mission to create a safe working environment aligns well with our values and corporate and social responsibility initiatives. We're proud to work with such a passionate group, and equally so by the incredible people they serve who work every day to improve the lives of those around them. So where are we today? Despite a good start to the year with high single-digit revenue growth, the shutdown in late March limited in-person training throughout the second quarter, resulting in a 36% decline in first-half revenues compared to the same period in 2019. Business activity has since steadily improved, with the company reporting a sequential increase in monthly revenues and profitability for each of the past 6 months, with recent monthly sales approaching 2019 levels. Anticipating the impact the slow second quarter would have on leverage, the company proactively negotiated with its lenders over the summer an amendment to replace its maximum leverage covenant with a minimum liquidity test in effect through the second quarter of 2021. Now, as we look out into next year, the environment remains somewhat uncertain given the ongoing volatility for hospitals and schools, particularly in the U.S. We've nevertheless remained focused on the company's long-term development, adding several new people to the leadership team and investing to accelerate corporate sales efforts, digitalization, and international expansion, including the recently announced introduction into France. So while we've lived through a difficult first year together, our long-term thesis remains intact, and we continue to invest in its pursuit. Next slide, please. With that, I'd like to very quickly introduce Tony Jace, CPI's CEO. During Tony's more than 10 years at the company's helm, the company has grown at a 14% compound annual growth rate, increased its presence in healthcare and education in the U.S., expanded internationally, and developed new products critical to its future growth, all while maintaining the company's mission-driven culture, which is central to its success and connection with its customers, and of course important to us as well. I would just end by saying that you learn a lot about who your partner is during an environment like this, particularly at the beginning of a new relationship. And I can confidently say that we are quite fortunate to have had him alongside us over the past several months. So thank you, Tony. And with that, I'll turn it over to you.
Well, thank you, Adam. And thank you, Andre and David, for giving me the opportunity to share the CPI story. I always love these presentations because Adam basically said everything that we're going to talk about on the slides. But I love to provide the nuance and sort of give you a bit of the animus of what animates CPI and these employees that we have here, and why we're so mission-driven and why we're so customer-focused. And it's because our customers are just amazing people, and they do amazing work, and we're just there to help them do that better. So welcome. This is beautiful Wisconsin. We're here in the heartland of the United States. We do have a couple offices in the UK, and we have one down in Sydney, Australia, and then also one down in North Carolina. So if we can go to the next slide. This is the business model, right? Before we get to the business model, there's a couple things I want to share. First of all, on the previous slide, we did talk about the missions and the statements around the mission that sort of animates us here on a daily basis. In that, we talk about stakeholders and the owners and investors being very key stakeholders for us, because we have learned over the past 10 years or 12 years that we've been owned by 4 different equity firms and families, that this partnership that we have, this partnership of growth, is very critical and vital to our ability to expand our mission and help others around the world. And you'll also see on the third line, looking back, that there's a note about financial stewardship, which is something very critical to us. Of course, there's outstanding customer value we have to deliver, and there's unparalleled quality, because what we deliver can actually be life or death in certain circumstances, but also the financial stewardship is something that we hold dear, because again, we know how critical that is for us to move forward. And so I want to thank Vandal and the investors and everybody else for helping us grow this mission as we move forward. So the business model, the slide, I can't see the slides, but hopefully we're on the business model slide. So before we get to the actual structure of that slide, I do want to take a second and talk about the purpose of CPI. Why does CPI exist? And what do we do? And what we do is we do 2 things very well. Over 40 years, we've had the ability to hone this model, but also hone in the value that we deliver to the broader society. And that is, we help professionals manage life's daily crisis moments. And then we also help professionals in the long-term care industry or the home health industry to help keep our parents or anybody that's living with dementia at their best abilities as possible. So again, we help professionals manage life's daily crisis moments, and we help professionals keep our seniors and our parents and anybody living with dementia at their best abilities as long as possible through therapeutic means. So those 2 ends have really driven our growth and our volume and our import in the world. So let's deconstruct a little bit. Why do crisis moments occur in workplaces? Why are healthcare workers 4 times more likely to be severely hurt at work than all other industries combined? And that is because there's a lot of people around this world that Adam talked a little bit about that are vulnerable. They're living with trauma. They're living with what we call neurodiverse diseases or states that has them communicate with us in a different manner than usual. And if you don't know how to communicate and how to manage these frequently then will become a crisis moment because they become frustrated, or they may be on abusing substances. So just like I talked earlier about, how owners and investors are critical to the CPI family, all of us here are in the CPI ecosystem. We all have friends and family who struggle with mental illness, who have depression, or who have anxiety. We have kids or nieces or nephews that have Down syndrome or autism or ADHD. And we all may have parents or aunts and uncles that live with dementia. So what we are here to do is support those professionals, those people who sort of weave around these special, vulnerable, and marginalized people in our society and help them deliver the care, welfare, safety, and security that all these people deserve, because every person has an intrinsic dignity and they deserve the best care possible. So our goal is to help these professionals discharge their care, discharge their instruction, and work with our seniors to the best abilities as possible. So how do we do that? We do that by leveraging a train-the-trainer model. So you'll see the 3 buckets on there. Between CPI, there's only 325 of us worldwide. So 70 of us are global professional instructors. We hold our first set of trainings. So that's where CPI is training our customers. And that is we're either renewing our current certified instructors that are in our customer base already, or we're creating new certified instructors, either replacing some of the churn that's happening in that middle bucket, or we're just adding new markets and new customers. Critically then, there's another set of training that occurs over to the right, and that is where the certified instructor, again, this is like a nurse or a teacher, trains their coworkers. Every year they'll train on average 40 of their coworkers. So there's over 100,000 of these training events that occur every year. Every time they train one of their coworkers in these critical skills that we give them around de-escalation, and in the rare instance where restrictive intervention is required, how to do that physically in a nonviolent manner. Every time they train their coworkers, they buy either a workbook or an e-learn seat from us. So they do that yearly. So there's a yearly recurring revenue pattern there. And in the middle bucket, we're training roughly 10 to 12,000 of those active certified instructors every year. We're renewing them every other year. So there's a 2-year cycle for that middle bucket. And then again, CPI is also adding every year new trainers to that 36,000 certified instructor pool. So the other thing that we've been able to hone over the years is our 5-year strategy is really to diversify our revenue streams. So a lot of the previous CEOs, which I'm thrilled to listen to, by the way, and I'm honored to share the stage with, talk about that as well, how critical culture is, but also how critical it is to have a diversified customer base and revenue base. So what you'll see is we have a nice exposure to healthcare and mental health. So these are behavioral health wards. We have a nice exposure to education, primarily K through 12, but also a bit of higher ed. And then also we have a nice 20% smattering of like human services or social services agencies, some retailers, some law enforcement people, and security firms. And then on the right, we also don't want to just fragment ourselves or diversify our revenue stream from an end market exposure standpoint, but we also want to grow our international presence and diversify our revenue streams with new geographies. When I first started 10 years ago, that list looked very different, very U.S.-centric, and we're slowly building our international expertise overall, and we are thrilled with Vandal to help us also broaden now into the continent in a much more formal and deep manner. Because again, these special people around the world deserve the best care possible, and it doesn't matter if they're in France or Germany or Africa or wherever. A kid with autism is the same worldwide. A senior living with Alzheimer's is the same worldwide. Next slide. So what I want to do here is I want to take us back a little bit and show that we are actually, that we've developed a muscle memory. When you're in business for 40 years, and when I took over, we were in the depth of the Great Recession back in March of 2009. We learn over time as a business how to manage through good times, medium times, and not so great times, which we're in right now. What we do is we hone in and we craft offensive game plans to make sure that the growth is invested and we can continue to do that, nurture that. But also we have defensive game plans. We look at the cost areas that we can leverage and take advantage of to make sure that there's that nice balance. I talk about the two lungs breathing together as we come out and we rebound out of where we were, in this case, the early spring that we have here. If we go to the next slide, this is our current financial slide. You'll see that we have a checkmark rebound going on, and Adam did a nice job of talking about that. So what you'll see is we have been improving every month since April in terms of the revenue that we're putting our books in and even our EBITDA. The other thing I want to note here is that we haven't stopped. So being an ESG-led firm, being a social impact firm, our healthcare customers, remember 40% of our revenue is in healthcare. Our healthcare customers have not taken a day off. We haven't taken a day off either. I tell the staff here at times, sometimes inconvenient to be a socially impact and aware company. But it's critical that we link arms with them. We run to the fire as they run to the fire. We have to be there when they need us. In Seattle earlier this year, when Seattle was the epicenter of the COVID crisis, we had customers there begging us to come there and train their staff because they knew that there was going to be a large influx of patients hitting their doors. And we went there. We've been back in the office creating these new products and doing a lot of PR and things like that because we know it's the right thing to do for our customers. And when the customers are successful, CPI is pulled along with it. So we've never stopped. We've never had a chance because our customers haven't stopped. It's slowed down, but we've never stopped. And now we are ramping up nicely out of that. The other thing Adam touched about this as well, but as we go through a volatile time like we have right now, and now as we look into 2021, we wanted to give ourselves a little bit of flexibility to make sure that we're investing in the right area and that we're delivering what we need to our customers at the right time. So we have to be super opportunistic and super, like I say, at the ready. So when that demand comes back by our customers, we are there that day, giving them this critical training that they need to be safe. So in order to do that, we did work with the banks, and we have a long-standing relationship with them. Our senior lender has been with us for 12 years through all 4 owners. They know us cold, and they know our culture, and they know who we are and what we're capable of doing. And Adam and the team did an amazing job of pulling us all together, negotiating this flexibility that we need to do the right thing for our customers and do the right thing for society. And that's where sometimes it's inconvenient to be a socially driven organization. But the liquidity covenant that we have is fine, and we are keen to overachieve going into next year. And we love this breathing room that we have to do the right thing even deeper. So the other thing I do want to pop out on this slide as well is that we have, over the last, let's say, 3 or 4 months, returned back to our EBITDA margins, our historic EBITDA margins that we've enjoyed. So as you can see, as the world is dealing with this pandemic and becoming a little bit more resilient, we're there, and we're taking advantage of this launch, this checkmark rebound as we see it. If we go to the next item, we're talking about sort of 2021 resiliency here. And what I like to do is I like to talk about the customer focus. So I talk about having a 70-20-10 philosophy as we do this. And 70% of our time is really focused on our current customers and the new customers in our core. That business model that we had earlier is really driven by these crisis moments that are occurring and this large demographic shift of seniors starting to hit long-term care or staying at home and having home health care come in. 70% needs to be there. 20% needs to be dedicated to all of these growth vehicles and vectors that we've been working with Vandal on to execute and continue to grow on a long-term basis. However, we have found over our 40-year period that in these volatile times, it's always keen and it's good to be intentional about allowing ourselves 10% of sort of surge capacity on the side to be opportunistic so that we can react appropriately in Q4 here, in Q1 and Q2, and have 10% of our time to either double down on growth, so we can throw that 10% if we see the world coming back nicer and faster and things like that, or we can focus on the core as well. So I want us to be, as we go through 2021, we know that we have to be opportunistic and have some capacity already set aside so that we can manage through these times. So the ESG thread, the next slide, it really talks to the, I know I missed the quick adaptation slide, but as we get to the ESG, that does animate everything that we do. It's not okay that our friends and family think that just because they're a nurse or just because they're a teacher, they have to go home at night bruised, scratched, or hurt. That's not okay. It does not have to be that way. Our training shows that and demonstrates that they don't have to do that. That's why our customer outcomes are so amazing, and that's why our top 500 customers have been with us for 20 years. Because when the certified instructor gets our training, the light bulb goes off, and they want to share it with as many of their coworkers, on average 40 coworkers in their hospital or school, and sort of regenerate a whole new environment of care, welfare, safety, and security. We are always on at CPI. Our customers are always on. Kids are back in school. You know, COVID is still coming back, and other illnesses are occurring, and we're never done. These crisis moments are increasing worldwide. You may have seen on some of the early press releases that we did some work around our brand building around retail and face mask wearing and social distancing, and what crisis moments might effectuate out of that. So we're always on, and we're always at the ready. So the last slide before we move into Q&A, it's really just a synopsis of, one, we're maintain the global leadership. In fact, we're seeing ourselves accelerate against competition from a global perspective. There's increasing demand. We all know that these crisis moments are on the increase. We all know the demographics of seniors with Alzheimer's is on the increase, and we have to deal with that as a society, and it's our responsibility to make sure that we're delivering the content there. We had a quick response to the crisis. The crisis really, what did it do to our customers? And the fact that we were able to stand up our virtualization, our virtual renewals in 10 days. The fact that we were able to decrease our in-person training time for our customers by 50% has really led them to respond very positively to CPI, and we're actually seeing new customers flow our way as a result of the way that we've dealt with that. And finally, we absolutely are committed to the next 40 years of growth, and we will continue to invest with Vandal. So with that, I know I was trying to shove like 30 gallons of milk into a 15-gallon pail as we're here in the Dairyland, but with that, I hand it over to Olivier for questions and answers.
Thank you very much, Tony. Indeed, it's now Q&A time. So once again, you can submit your questions in writing through the webcast platform or via the dedicated phone line in English only. First question from the web. Some questions are also for Adam, so there are a lot of questions. First question, CPI is mostly active in Anglo-Saxon countries. Is it due to Anglo-Saxon laws as opposed to French laws or European laws which favor needs for CPI's training?
Yes. As we look, there's a lot of opportunity worldwide. So, and again, we know that these children and these adults and our friends and family exist. So it is easier for us now, while we have such a large growth vector and trajectory that we can execute against, that we find the most favorable areas for us to continue to build what I talked over earlier, that organizational muscle to grow and build up in these various end markets and geographies. So yes, I mean, although that being said, we also are very at the front working with advocacy groups and others to generate laws, and we work with legal entities to make sure that if the laws are underserved, if these vulnerable people are underserved in a given geography, we do work with the authorities to help build out a culture of care driven by rules, policies, and legislation. So an example of that is working with the social care industry in Hong Kong when we first introduced ourselves here. When we first went to Australia, a similar type thing that we had to do there. So we're competent and we like doing that because it is actually the right thing to do. But yeah, our focus is on those geographies that we can have a quicker ramp so that we can more elegantly deliver our training to as many people as possible.
Thank you. To what extent could you end up with a structurally more digital, less costly post-COVID organization?
Yeah, so our core program, because it's a defensive mode where we train physicals how to manage in these rare instances where the aggression does turn physical. We have to train these response teams and these.
Madam, are you still there, or is it a global technical issue?
Can you hear me, Olivier?
Yes, Adam.
I'm here. Can you hear me?
Yeah. So while we are trying to recover the line with Tony, I'm gonna continue the Q&As if you agree. So your press release mentions a covenant waiver until June 2021. If the current COVID second wave is the global economy, would you consider reinjected equity in the company?
I think our current expectation is that the covenant renegotiation gives us more than enough cushion to get through that point next year when the covenant reverts. But I suppose we'll reevaluate as we get closer to that point.
Thank you. I think Tony is back now. Tony, do you hear us?
Yes, I do.
Yes, great. Thank you. So I'm continuing in the Q&As. Sorry for this technical problem. When will you settle in France?
Start.
When will we what in France?
When will you install your company in France? Offer your services in France?
Yeah, we've been in France for a couple years already. We've been working with Euriops. You may be familiar with them. But, given this amazing partnership with Vandal, and we have the ability now to expand even further and more formally in France. So we've hired our first employees just a couple months ago there, and we have a very intentional game plan, which is built out over the next 3 years to expand into France in a much more structural manner and deliver amazing content to people that need it there.
Thank you. A question that looks like this one. What's the growth opportunity outside of North America for you?
The growth opportunity is amazing. I think, and Adam may talk to this as well, but really the focus for us is choosing those growth vectors that we feel that we can be most monetizable and successful in and deliver the quality that those professionals need. However, as you look at the tangential market, so there's a lot just in our core still that we can do. However, given even this crisis, the COVID pandemic, when you look at where these crisis moments are occurring, they're now occurring more often at home because kids are at home more often, or they're occurring in other workplaces or other settings that they may not have before because of some of the restrictions that are placed on people. So we are looking at these end markets in the U.S. as well to broaden our reach. And a lot of our PR that we've been doing, and it's been very successfully received, has been around that, and we're getting really good traction there. The other thing that we really are looking at very deeply as well, because we're undergoing a very deep strategic exercise right now, is every person needs our training. So families need our training. There's a consumer element to our business that is needed by everybody worldwide. So right now, I've talked over professionals a lot and business to business and, the train-the-trainer, things like that. But allow yourself to think about the skills and strategies that we have around de-escalation, and not just verbal, but also non-verbals that are done. Anybody can use those, and that will absolutely transform the way that you interact with others and sort of de-escalate a lot of potential crisis moments in your own life.
Thank you. Very simple question. Is Allied Universal a client of CPI?
Yes, they are a client, as well as a lot of the hospitals and workplaces where they subcontract their guards into are clients as well. So it's actually the hospital will be training. So our a nurse at that hospital will be training the Allied staff security group as well. So it's a very great relationship that we have with Allied.
Okay, a question that is a bit long. How have your revenues and EBITDA developed on a 9-month basis? I remind people that we do not disclose EBITDA on a 9-month basis. 2, please explain what percentage of your U.S. sales are directly driven by U.S. regulations. 3, are there any independent indicators available out there or CPI developed indicators to measure the increase of violence in U.S. workplace over the last 20 years?
Okay, that's a lot. And so, Olivier, you may have to do the last one again. But the first one, well, in terms of the U.S. revenues driven, or just revenues in general, driven by legislation, there's not a direct correlation between a law and the fact that they're using CPI training. What we talk about is it's legislatively influenced, and that's why we are always in various state houses, or even in the UK, working with BUILD and that restraint reduction network there. Some of these governmental entities that audit these various workplaces, because as we strengthen these rules around, my gosh, if you're going to put your hands and restrict the movement of a senior or someone with substance abuse or a psychotic episode or a child with Down syndrome, you better have some amazing training, and you better have that blue card that you saw in one of the earlier slides. That's like a driver's license that proves that you've been trained and allowed to intervene with that vulnerable person. So there's a legislative influence, but there's not really a direct link from a law saying you must have CPI. But because these laws are passed and because they use our language a lot of time, we will write a lot of the language in these laws, it does accrue to us very well, because we are able to put in things about you need to have scale, you need to be able to train worldwide, you need to have accreditation from many states, things like that, which are all defensible moats that we own and no one else owns. What was the first question again? Oh, about the margins and things like that. So that checkmark recovery is, and I think Adam talked about it very well. We are coming back very close to 2019 results, and granted, November and December are sort of off periods because there's only 3 weeks of training in November and 3 weeks of training in December in the U.S. Even with that, when you look back, we're having a very like type performance against 2019. So that's why that 10% of opportunistic sort of dry powder, you might want to call it, is so critical to us as we go through Q1 and Q2, so that we can fill in these holes if a rolling shutdown does occur again, and we can maintain this recovery and this rebound that we're seeing. What was the last one again, Olivier?
To make it simple, are there indicators about violence on the workplace in the U.S.? And if not, did you create some?
Yes. So we do have, yes. So we have such a large install base of customers within the U.S. or even Canada or even the U.K. When we survey our customers, we can come up with better data than a lot of government entities do. So that's full stop there. And the reason for that is because our customers have a common nomenclature of what is a de-escalation, what is a restraint, and what is what we call therapeutic rapport. How do we handle these so that it doesn't happen again, these sessions where it doesn't happen again? All those are tracked, and we can track that. But the definition of each one of those, it's common within CPI world. Governments, when they ask for that, and any separate entity can define it differently. So some schools may really say a restraint, is 10 minutes or more. Or some schools may be, if I restrict the movement of a student for a minute, that's considered a restraint. So that being said, there is a lot of good data in the Bureau of Labor Statistics that we do use, and we are building what we call Riptide. It's a beautiful database right now of all external tracking mechanisms and our internals so that we can share that with the world, because we do at times will publish what the incidents, the crisis moments, this is where they're occurring, and we're seeing an influx. Like we just had a paper around the high increase of psychotic episodes of teens ingesting marijuana in Colorado, and what that's doing to the emergency rooms there, and how to manage those crisis moments.
So many thanks, Tony. Many thanks, Adam. But I'm sorry, the time allotted for question has now expired. We will call back all the people who sent question on the web. We could not answer right now. Sorry for that. I'm going to leave the floor now to André for the last word about this Investor Day. Thank you very much.
Thank you, Tony. Thank you, Olivier. Thank you all for your attention. We hope you enjoyed this virtual event. It worked well. There was a small glitch, but overall, I think our prayers have been met. I hope that you all come out of this with a sense that there is excitement, that we have very good leaders running our businesses. We talked about very different industries. We talked about paints, decorative paints across Europe. We talked about packaging in many jurisdictions, pharma, consumer. We talked about de-escalation training. We talked about the healthcare system, the school system in the U.S. And we talked about Stahl in very many products that you all consume. As you see, we have a very dynamic bunch of CEOs. We enjoy working together, and we're looking to take with their teams to take all these businesses to the next level. So looking forward to seeing you in person next time or in road shows. And then in the interval, our investor relations team is available to answer your questions. We are too, and we wish you the best and a safe end of the year. Thank you very much.
Stay well.
Stay well.